Under the leadership of the Chinese Communist Party, or CCP, the rift between China and the West continues to widen, and the economy continues to deteriorate. Investors' optimism about China is now gone, and they are pulling out of the country's sagging economy, causing a major shift in global markets. So where's the world's capital going as it pulls out of China? We discuss it in this episode. Investor pessimism about China is arguably being exacerbated on a daily basis as more and more multinational companies are telling them that you're not wrong to feel that way. For example, some of the world's top food, beverage, and technology companies, including Starbucks, Pandora, and Carlsberg, have recently joined the ranks. They made pessimistic remarks when reporting earnings for the fourth quarter of 2023. They highlighted the challenges facing consumer goods companies across the spectrum, from cell phones to cars to necklaces. Consumers have tightened their purse strings even more and are reluctant to spend amid China's uncertain job outlook, a plummeting stock market, and declining real estate values. Currently, it's around the Chinese New Year holiday, and it's supposed to be the peak season for spending and a good time for businesses. But major multinationals aren't feeling it. Pandora Jewelry's fourth quarter sales fell short of expectations. Its China CEO said in a February 7th interview with Reuters, "People ask me why I'm so worried. China only accounts for 2% of the company's revenue." That's one way of looking at it, but if you say that China has 1.4 billion people, which is the largest jewelry market in the world, then you get a different perspective, he said. "I think it's going to be a long and tedious journey." The chief executive of Carlsberg, the world's third largest brewer, said he was cautiously optimistic that the downturn would stabilize and that he expected other Asian markets to improve, but he couldn't predict when China would recover. Linda, the world's leading industrial gases company, was similarly reluctant to say much about the market outlook for China, indicating that the lack of momentum over the past year would continue until 2024. Its chief executive said, "Our view is that the first half of this year is likely to see a sustained modest recovery, and then the second half of the year we will have to watch what happens." On February 7th, 2024, official data released by China showed that electric vehicle sales in the country fell 38.8% in January compared to the previous year, the first decline since August 2023. It has underscored concerns that the economy appears to be frozen since the start of 2024. Around the Chinese New Year on February 10th, 2024, China's stock market plummeted to a 5-year low. The wealth of Chinese stockholders has basically shrunk by about 60% compared to 2021. As we previously reported, it has led some little pinks to even start chanting dissenting slogans, "Down with the Chinese Communist Party." China's stock market crash shows that Chinese people no longer have confidence in spending and investing. Stockholders are gradually waking up, realizing that the Chinese stock market has been a systemic trap since its inception. It was designed to squeeze money from the Chinese chives, benefiting the CCP regime, state-owned enterprises, and the government. The stock exchange is only a financing tool. Credibility is the basis of the stock market, and the Chinese stock market has lost it all. The industry-wide crisis of falsification by listed companies, loose guarantees by banks, influence peddling of government officials, and squandering and misappropriation of deposits by securities firms have been intertwined, causing the stock market to lose its credibility. China's stock market is destroying the country's middle class as its economy tanks. Those who have been lulled into the stock market by the party media in the last 2 years have become the, so to speak, sacrifices of this era. All of this is further deepening investor anxiety over the operations of multinational companies in China and the ability of the communist government to revitalize the economy. So, with China's economy in trouble and the stock market continuing to plummet, where is all the capital going? We have observed that one direction for the capital leaving China is to return to the US. The total market capitalization of American companies now accounts for nearly half of the world's stock market capitalization, reaching the highest level in 2 decades. By the end of 2023, foreign investors sold about 90% of the $33 billion in Chinese stocks they bought earlier in the same year. The sell-off continues in 2024. Nikkei News reports that quick FactSet data shows that mainland Chinese and Hong Kong companies have lost $1.7 trillion in market capitalization since the end of 2023. In dollar terms, China's share of global market capitalization has fallen to about 10%. Its share is roughly half of its peak in 2015, which was nearly 20%. Over the same period, total U.S. market capitalization increased by 1.4 trillion and reached 51 trillion, bringing its share to 48.1% globally. It's the highest level since September 2003. The gap between the US and China has widened to the largest amount since records began in 2001. China's e-commerce leading player Alibaba Group and gaming and social media conglomerate Tencent Holdings have lost a combined 31 billion in market value over the same period. The report said that at the beginning of February 2024, the world's 500 most valuable companies included 236 American companies, an increase of 15% from 3 years ago. The number of Chinese companies declined by about 60% to 35 companies. Baidu, Jingdong, and EV maker NIO all fell off the list. At the moment, Chinese tech companies are reconsidering their expansion plans. Alibaba is considering selling some of its consumer businesses, including grocery stores. It would be a major and strategic shift for the conglomerate seeking to bridge online and in-person shopping. Chipmaker NVIDIA is the world's sixth most valuable company, with a near monopoly in high-end chips. In 2022, due to concerns over the CCP's military-to-civilian integration policy, the U.S. imposed a ban on exports of semiconductors and chip equipment to China. It has not only deprived Chinese firms such as Tencent of a ready access to high-end chips, but also caused SMIC to lose roughly 1/4 of its market capitalization since the beginning of 2024. Last quarter, the flagship fund of U.S. asset manager Baron Capital cut its holdings of Chinese stocks to zero for the first time since the fund's inception in 2012. Portfolio manager Alex Umansky cited a regulatory crackdown by the CCP, as well as rising geopolitical tensions. Prosus, the largest shareholder in Tencent Holdings and the Dutch subsidiary of Naspers Group of South Africa, said it has been reducing its stake in Tencent by 2% to 3% annually. It expects its stake to fall to around 24 to 25% by the end of this year. The above cases suggest that overseas investors' optimism about the Chinese market is now gone. They rush to leave China amid its sluggish economy. Apart from the US, they are looking for other Asian countries to invest in. India and Japan have become two of the most popular countries for investors. While the CCP regime is increasingly becoming a threat to the global order, India is seen as a potential counterweight. India is increasingly capable of becoming a viable manufacturing alternative. Countries such as the US also see the need for a solid commercial relationship with India. Investors are closely watching India's growth trajectory. It's the fastest growing major economy in the world, and Prime Minister Modi is expanding its infrastructure to attract foreign investment and replace China in the global supply chain. Vikas Prasad, portfolio manager at M&G Investment Management, told Bloomberg, "There are several reasons why people are interested in India, and one of them is it's not China." India is indeed transforming into a large, dynamic economy that is opening up to the world in new ways. Modi plans to make India a new engine of growth for the world economy. India's finance minister recently said in his budget speech that the government would raise infrastructure spending by 11% to 11.1 trillion rupees, or about 134 billion, in the next fiscal year.
India has seized the moment. Why do I say that? I say that because you're not just transitioning from the 10th largest economy to the 5th largest economy. You're growing at 7.2% last 3 quarters, the coming quarter and the next year. All the forecasters and all those who make it their professional duty to assess evolving situations are pointing a good picture.
These 4 pillars, investment in infrastructure, both physical as well as digital, inclusive growth, focus on manufacturing, and immense amount of simplification. That is what has given us this growth, and with 95% confidence interval, we can all make an assessment that whole of the next decade will be growing, India will be growing at 6 to 8%, mostly on the upper side of this band, with a moderate inflation of 4 to 6%, in a very consistent way.
Though no one thinks it'll be a smooth ride for India, regardless, everyone from large hedge funds to retail investors are investing in the South Asian country. In the last 10 months, the flow of investment has boosted the India index by a third. According to the official data from India, it has attracted $20 billion in foreign capital in 2023. History has shown that India's economic growth is closely correlated with its stock market value. GDP and market capitalization have grown in parallel over the past 2 decades, from $500 billion to $3.5 trillion. According to Money Flow Monitor (EPFR), since 2022, active bond funds have put 50 cents in India for every dollar withdrawn from China. In mid-January 2024, India briefly overtook Hong Kong to become the world's 4th largest stock market. In the view of some investors, this trend will continue to progress. Morgan Stanley predicts that by 2030, the Indian stock market will be the 3rd largest in the world. Japanese retail investors who have traditionally favored the US stock market have also become keen to invest in India. Currently, there are 5 India-focused mutual funds in Japan that rank among the top 20 in terms of inflows. Marshall Wace Hedge Fund Group points to India's strong economic growth and relatively stable political situation as reasons to remain optimistic about India's continued economic growth. India is also building a large technology ecosystem aimed at pulling more of its population into the digital marketplace. The International Monetary Fund expects India's GDP to grow by 6.5% in 2024, while China's growth is expected to be 4.6%. This optimism has made Indian stocks one of the most expensive in the world. Experts are also hinting at its potential risks. The CEO of Kotak Mutual Fund told Reuters, India's premium valuations are due to other markets underperforming, and if they start performing well, things will change. This means the Indian market needs to keep delivering better and sustained earnings growth. Also, this May's general election is at the forefront of the investors' risk maps. Despite Modi's popularity and his party's expected ability to maintain a majority in parliament, a less-than-expected result could weaken the economic measures taken by the Modi government. Critics argue that Modi's social agenda favors India's Hindu majority, but the country's vast cultural differences, with more than 200 million religious minorities, could threaten its stability. Even with these risks, some investors say they are in it for the long haul. They argue that India's per capita income is still low and that it can expand for years in the long run. The head of investment strategy at Mellon Investment Management told Bloomberg, "The potential for scandal, social polarization, and political strife is always there. Nonetheless, the volatility is worth it if you believe that the Indian economy is likely to grow to more than $8 trillion in the next decade or so." Indeed, Chinese stockholders have taken notice of India. Chinese stockholders who experienced the A-shares crash in early February this year are extremely frustrated and furious. They first flocked to the Weibo account of the U.S. Embassy in China to vent their anger. On February 2nd, the U.S. Embassy posted 2 articles about a spokesman's New Year's greeting to the Chinese people and giraffe conservation. Underneath the articles were comments from Chinese netizens complaining about the stock market crash and the economic recession. Some even insinuated that Communist Party General Secretary Xi Jinping should be held accountable for the situation. All in all, these Chinese weren't attacking the US but China. With more than 140,000 comments flooded in, it was dubbed the Giraffe Incident or Giraffe Movement. China's cyber censors started a massive campaign to delete the messages in the early morning hours of February 3rd. Chinese netizens responded by leaving more comments in a relay fashion, making it a challenge for the Chinese authorities to delete them all. After the message under the US consulate was deleted, these Chinese stockholders went to India. At the time, the Indian stock market index was approaching 72,000 points. The Chinese had already noticed that the Indian stock market had been up and down for more than 20 years, rising from around 3,000 points to 72,000 points. They marveled at how the Indian stock market has risen 24 times in 20 years or so. Below the posting by the Indian Embassy in China on February 2nd, Chinese shareholders have amassed more than 2,600 responses as of press time. It was tens to 100 times the number of responses compared to the other posts, despite constant deletions by online censors. The Chinese usually refer to India as Sangge, the third brother. In these posts, one comment said, Sangge, I love you. Another said, we don't deserve to call India Sangge, the third brother. We need to call it Master San, the third master, save us. One apologized. I used to curse the US and India, but now I'm supporting you. I am sorry I was wrong. Another said, Sangge, forgive me for being short-sighted and narrow-minded like a frog at the bottom of a well before. A Chinese netizen asked directly, are you going to grow to 100,000 points? The people of India are really blessed. Someone said, I am so envious of India's stock market, so bull. One stated, great country, great financial market, thumbs up for India. Another individual wondered, we are just across the Himalayas, how can there be so much difference? One person said, hats off to India, let's learn from India. Thumbs up for Modi. In the 5 weeks since the beginning of this year, more than 400 billion Japanese yen has flowed into overseas Japanese stock exchange traded funds, setting a new high in 6 months. Not only professional institutional investors, but also overseas individual investors from China are actively buying.